Tesla, not looking the best. We're under 212, which we talked about was a very significant level to hold. We could still bounce back over it. As of right now, it's 2 p.m. Eastern Standard Time, so the market will close in 2 hours. We'll see where we end up closing around there. But we've been watching these big money levels. We've been talking about this change of character level, basically from 212 to 214, and how last time we pushed through this resistance, we had this change of character, and we saw Tesla run all the way up about 36%. Now, this change of character / support level is going to hold steady now as we come into our current time. And you can see that we respected that level very, very easily. Now, the 1, 2, 3, 4, 5, these are Elliott wave impulses that I've drawn. This is not definitely going to happen. This is just something that we were toying with yesterday. And this could be the potential third leg of an Elliott wave impulse, which could drive us 26% down to about $160 on Tesla. In yesterday's video, we also went over what a market bubble looks like, and we put Tesla's monthly chart next to, objectively, a market bubble chart. And if you want to see the full video on that and the full explanation, I highly recommend you check it out. It's in yesterday's video. So looking at this moment now, I do think we will probably see Tesla move down to 160. Price action looks very weak. We pushed up and tested this old change of character level and rejected. What I would have liked to see was that bounce back to 240 and then rejection. So since we have break of structure, which is not good, then we broke through this old change of character and we have a fair value gap down to 193. It's looking like Tesla's probably going to move its way back down to 160, as we've been saying, for the past couple of weeks. Now, a lot of people have been talking about yield curves, talking about treasury bonds, and I want to briefly explain this and how this actually messes with the market as a whole so that you guys can get an understanding fundamentally of what could happen over the next couple of months. And this is going to be very important as well, because what we're going to go over is how this could cause a potential recession. And obviously a company like Tesla, which I'm an objective long-term shareholder, will not do well during a recession. We're just going to be completely honest here. So the PDF to this is down in the description. And the first thing we're going to start with is, what is a bond? I know that this might sound like a snooze fest because the only time you think of bonds is the bonds that your family probably got you when you were a kid, or you think of old dudes who are just buying bonds. But basically, a bond is going to be a fixed income instrument that represents a loan made by an investor. Now, the bonds that you should be buying most of the time, that I don't buy, I'm 34, I don't need to be buying bonds in my opinion right now, but institutional investors, they want, especially during times of volatility, they want a guaranteed fixed income on their investment for the next couple of years or next couple of months. They would rather do that, especially when the market's rocky, which we're going to talk about later on, and they'd rather take that fixed interest rate and that return over potentially risking capital. And we're not talking about like people like you and me. We're talking about massive institutional investors, massive hedge funds whose goal is to protect $300, $400, $500, $800 million during a recession, or when they feel a recession is going to happen. So a bond is just an IOU between a lender and a borrower. The biggest thing that you have to understand is that a shorter term bond will adjust much more rapidly to the changes in interest rates than a longer term bond. This is because it's closer to maturity. So as interest rates are pinging back and forth, you will see more volatility within the price or the yield of the US Treasury. So I gave you guys in this example a 2-year Treasury. And as we look at the 2-year versus the 10-year in a bit, you're going to get an understanding of where this divergence is occurring, and you'll start to actually have a fundamental understanding, not just throwing words around of like yield curves, but a fundamental understanding of what a yield curve inversion means and why it's really not good. And it's actually usually a sign of a very bad recession. So as we said, the 2 years and the shorter time frames, they are going to react much quicker. Think of this kind of like an EMA. An 11 EMA or an 11 moving average is going to move and reflect the price much faster and much more volatile manner than like a 200 SMA that has a ton of time till maturity in this aspect, that's slowly moving its way up or down with the overall trend. So an inverted yield curve. This simply occurs when a shorter term bond's yield is quickly and drastically increased, and therefore the return on a shorter term bond is actually higher than a longer term bond. And this does not make any sense logically, because when you think about an investment, the longer the time horizon, the more risk you're bringing on, you should be making more money for making that type of commitment. Whereas right now, well, we'll go actually into what's happening at this exact moment, but during an inverted yield curve, you could actually get more money from a shorter term bond than going out longer term. And this is obviously not a good sign. So logically, like we said, you should be making more money the longer that you invest. And if you overlay a 2 and a 10-year treasury yield bond, historical data is going to suggest that every time this inverted yield curve has occurred, it precedes a market crash, which means usually the yield curve holds, and then we get that crash. So this is concerning for the economy, obviously, and this is going to be the full breakdown. You're going to see the 2 crossing over the 10, and in dark, or I should say light gray, that's when the yield curve inverted, and then usually that is followed by a crash. So in 2020, back here in 2000 and 2003, 92, 1980, etc., etc. So if you want to see the full breakdown of that, you can go and get that within the PDF. This is concerning for the economy and the stock market specifically, because as longer term yields rise back over time to catch up to where they really should be, it's going to make borrowing and investing significantly less appealing. And we're not talking here, when we look at the economy, of just the stock market. It's if entrepreneurs aren't going to go borrow money to buy businesses, people aren't going to have more jobs that could be created. If big companies like Amazon, Apple, all these other companies think that it's not worth going and taking loans out for payroll or for research and development, or taking a loan out to grow, if that's not worth it, then they're just not going to do it, which is in turn going to bring down GDP, which is going to bring slower economic growth, which will obviously end up in a recession. So currently, even in the real estate market, interest rates are hitting 8% highs. So it's assumed that if a long-term bond yields continue to rise, housing interest will rise, and that will also increase, making property purchases even less attractive. The reason that the market right now, and we can do a full video if you guys want me to do this in the future. I don't know how much the housing market really gets you guys going, but it's how I made my first bit of money to therefore put into the stock market. But the reason that the housing market is holding on so strong right now is because even though interest rates are high, supply is still low. Because if you got in back between basically 2014 to 2 years ago, your interest rate is probably 3, 4, 5, 6%. So going out and purchasing another property right now doesn't make sense. And it's not even like you're going to get a cheaper loan. So there's no reason to do it, which means that people are still trying to go get properties, but there's not enough supply. This is normally when you see, like, the last sign the housing market's going to crash is mass development, because developers will notice the hole in the market and they'll say, applications for loans are still high, interest rates are still decent, but nobody's selling their property. How do we take advantage of that? And the way you do it, in the eyes of most developers, is you go and develop properties so that you can create liquidity in the market to go sell those properties for hopefully significantly more than you purchased. And sometimes you'll see the last leg before the market crashes, and I'm not saying this real estate market's going to crash anytime soon, is developers over leveraging, looking to fill that market gap. So we'll see what ends up happening. If you want a full analysis, I can definitely do that. Something else you have to understand too is that rising interest rates will also just discourage, like we said earlier, companies from expanding just in general, because it's not as lucrative and it's not as cheap to go bring on corporate debt. So as yields rise on a longer term bonds, institutional investors are enticed because they lock in a confirmed profit with little to no risk. This often results in a withdrawal of funds from other investments, such as the US stock market. So as 10-year treasury bonds are going to continue to rise, institutional investors, and think about this, not you and me, you have to put the mindset on of a portfolio manager of a $500, $600, $800 million hedge fund. As you look at the next 4 years, you say we have a lot of potential for the W word. I don't know if I can even say this on YouTube, whatever, war, just across the world. We have interest rates that are still going up. We still have to deal with inflation. We have right now the inverted yield curve. There's so much out there that if I'm looking to hold on to all of the money that I have made in my hedge fund over the past 3 years, what am I going to do? Risk it on overvalued growth companies, which is not, that's the first thing that gets murdered, and we're going to talk about that in a minute, put it into a growth company like Amazon, Tesla, et cetera, et cetera. We'll go over that option. Or am I going to put it in a 10-year bond that I know is going to get me a pretty decent return that's guaranteed? What's the more lucrative offer? We're not looking here about someone trying to turn $5,000 into 500 grand. We're talking about people who are millionaires and billionaires just trying to hold on to their money and beat inflation and get a decent return for, if it is a hedge fund, for their clients, so that they can just charge them money the entire time for transaction fees and whatever fees they also charge. So from a big whale standpoint, it's starting to look better as yields for the 10-year and 30-year and everything, the longer ones rise. It's probably better to go purchasing those. So what stocks are going to get hurt first? And we see this happen just a lot in general, but it's normally short-term and very small growth companies who usually aren't putting out any types of profits or very little profit, that usually are extremely overvalued in the short term, but more so have little to no backbone as to an actual return on investment, because growth companies are not usually valued by the amount of money that they're going to give back to a shareholder. If you were investing in Tesla over the past 5 to 10 years, which I've been investing in Tesla since 2017, you know that the company has just recently, within the past couple of years, become profitable. They don't offer any dividend. So the only way that you're going to make money back as an investor at this point is by hoping that you can sell your shares at a later date. And what's at least telling you as an investor, or should be, that you're going to get your money back and that you will be able to sell them at a higher price is going to be if the company is making more money and if margins are going up. So if you're watching a company's fundamentals over years and years, like Tesla, and you see the demand is continuing to go up, you see that the leadership, which I'm not saying all this is going to happen or did happen or whatever, but if you're just looking at a company and you're saying, I think the management's great, I think that people don't understand what really gives this company value. That's where arbitrage comes from. That's how we saw Tesla go up 1,000%, in the last 5 years. But you really also can look at how much money is the company making in net profits, and as their revenue grows, are their net profits growing? Because if they're making more money, though on the top line, like they're growing, but they're not keeping more money, that's not a good sign. So normally, smaller tech companies that aren't even churning a profit are going to get murdered first, because it's speculation. They're not actually proving profitability and that the company can ever be profitable. So any company that's not profitable usually is going to get murdered first. Then we have things like big tech. So Tesla, FANG, S&P 500, most of those big things that drive the market, like Meta, Netflix, Apple, Amazon, etc. Those normally, if you're a big hedge fund, do you really think you want to be investing in Tesla up at the 300s? No. Institutionally, there's a big level down at 165. There's another level down at 120. So it's not as enticing to you because you're probably scaling out of all of your profits that you got in on Tesla from 2020 to 2021 to 2022. You have to understand, these people work on a massive time frame, right? They're not hustlers. They're not like us, like, oh, what's going to happen in the next couple of months? Like, these people are like building positions over years and years. So you have to start to think their way. And so what does this lead me to ultimately say? The same thing that I've been saying for a long time. I don't think the market should be anywhere near where it's at. But I've been saying that for a very long time, and I'll continue to trade what's in front of me. I'll continue to trade with the current trend. And since we're underneath $207/$212, I'm officially a bear. And if we bounce and we hold over and we start to push up to 280 and 300 and we continue to hold the structure, I'm a bull. Like, I'm not a perma bull or a perma bear. If I'm investing in a company like Tesla, I don't care what's happening in the next couple of months, but I'm also a trader. So I need to trade what's in front of me, and I need to remove and detach my long-term investor's mindset from my daily trades. And I also have to spend time to sit back, look at the economic landscape, ponder about my position as a long-term investor, and make decisions through that side of the brain. So I hope this video helped, guys. If you want more fundamental videos talking about boring things in the market that we can make fun or at least simple for you to understand, or if you want some fundamental videos on Tesla, please let me know. As always, guys, thanks for all the support. I'll see you next time. Peace.